Valuation is the heart of investing. Without it, we're just guessing in the dark. It's the process that lets us cut through the noise and get to the real question. What is this business truly worth, and why? It's how we figure out what a business is really worth. Not just what the market says today, but what it could be worth tomorrow. Think of it like buying a house. You compare prices in the neighborhood, check the condition, and decide if it's a good deal or if you should keep looking. You wouldn't buy a house just because it looks nice from the outside. The same logic applies to stocks. We want to buy great businesses at fair prices, not just chase the latest trend or hype. But what's fair in a market that's always changing, where prices can swing wildly from day to day? That's where valuation multiples come in. Simple ratios that help us compare companies quickly, even across different industries or business models. These multiples, like price to earnings or price to sales, show if a stock is expensive or cheap relative to its peers, giving us a shortcut to deeper analysis. Imagine two vendors selling apples. One charges more, but the apple is bigger and juicier. You'd want to know if the higher price is justified by better quality. Multiples help us look past the sticker price and focus on what we're actually getting for our money, making smarter choices. They force us to ask, what are we really getting for our money? Are we paying for growth, stability, or just hype? In this video, we'll break down two of the most popular valuation tools, the price to earnings, PE ratio, and the enterprise value to EBITDA, EBITDA ratio, and see how investors use them every day. We'll see what they measure, how they work, and when to use each one to make better investment decisions. Mastering these tools is the first step to moving from speculation to smart investing. Let's get started on your journey to understanding value. The price to earnings, or PE, ratio is the classic valuation metric that many investors turn to first when evaluating a stock. It tells you how much investors are willing to pay for each dollar of a company's earnings. Just divide the current stock price by the company's earnings per share, or EPS. For example, if a stock trades at $50 and the company earns $2 per share, the PE ratio is 25. This means investors are paying $25 for every $1 of earnings. Now let's compare two companies. Company A has a PE of 10, while Company B has a PE of 25. At first glance, Company A seems much cheaper. On the surface, A looks like the better value since you're paying less for each dollar of earnings. But a low PE doesn't always mean a bargain. It could signal that investors expect little or no growth from the company in the future. On the other hand, a high PE ratio means investors expect big growth and are willing to pay a premium for that potential. The PE ratio is a quick and easy way to compare companies, but it's not the whole story and has its limitations. It doesn't work for unprofitable companies, and sometimes earnings can be distorted by accounting tricks or one-time events. Still, the PE ratio is a great first filter for spotting potential value or hype, helping investors quickly narrow down their stock choices before digging deeper. The EV/EBITDA multiple gives a fuller picture. EV, or enterprise value, is the total value of a company, market cap plus debt minus cash. EBITDA stands for earnings before interest, taxes, depreciation, and amortization, a rough measure of operating cash flow. Divide EV by EBITDA, and you see how many years of cash flow it would take to buy the whole business. This ratio is capital structure neutral, so it works well for comparing companies with different debt levels. It's especially useful in industries with big differences in debt or depreciation, like telecom or manufacturing. EV/EBITDA helps you compare core profitability, regardless of how a company is financed. The PE ratio is simple and intuitive, great for comparing stable, profitable companies. It's widely used because it's easy to calculate and understand, but it ignores debt and can be skewed by accounting choices, which can sometimes paint a misleading picture. Two companies with the same PE might have very different risk profiles if one is loaded with debt, making it a less reliable measure in such cases. EV/EBITDA shines here, since it factors in debt and strips out accounting noise, providing a clearer picture of operational performance. It's better for capital-intensive industries and for comparing companies with different financial structures, offering a more nuanced view. Still, EBITDA isn't perfect. It can overstate cash flow by ignoring capital spending, which is crucial for long-term sustainability. And calculating EBITDA takes a few extra steps, making it a bit more complex to use. No single ratio tells the whole story. Each offers a different lens through which to view a company's financial health. Use both to get a more complete view, ensuring a balanced and informed analysis. Use the PE ratio for mature, stable companies with similar debt levels. Think consumer staples or utilities. For companies with lots of debt or in capital-heavy industries, EV/EBITDA is your go-to. If a company has negative earnings, PE won't work, but EV/EBITDA might. Start with PE to screen for value, then check EV/EBITDA for a deeper look. If the two ratios tell different stories, dig deeper. There may be hidden risks. Never rely on just one number. Combine metrics, understand what they reveal, and always connect the numbers to the real business. That's how you move from guessing to real investing. 9.